everyone, my name is DEVANSHU and today I'll be presenting my project on stock sentiment analysis using machine learning. We'll be exploring how we can use public sentiment extracted from news data to predict stock market trends and build a trading strategy. This is the project overview slide. The stock market, we all know, is a very non-linear and dynamic system. While traditional analysis focuses on financials, it's widely accepted that human emotion or investor sentiment plays a huge role. In fact, Robert Schiller demonstrated that investor behavior was a key driver in major market crashes like Black Monday 1987. This is where our project begins. We are using sentiment analysis, which is a technique to extract and quantify the viewpoints, attitudes, and emotions from textual data. The core goal of this project is to capture the public sentiment from the news and headlines and financial articles, and then use it to predict whether the market trend will be bullish or bearish. Ultimately, this prediction will help us decide whether to buy or sell the stock to build a profitable trading portfolio. Here's a high-level look at our project's workflow. First is scrape training data, second is sentiment analysis and feature extraction, then training the model evaluation, and calculating portfolio. We start by collecting a massive amount of the text data over a decade's worth. Our process is split into two main phases. First is training, second is testing. In training, we built and trained our machine learning models using a dataset spanning from 2012 to 2021, and in testing, we tested our model's prediction and simulated our trading strategy on a future dataset from 2022 to 23 to see how it would have performed in the real world. The entire flow from the data collection to the final portfolio is what we'll be diving into next step by step. First step is scrape off training data. We all know the foundation of any machine learning project is its data. Our first major challenge was to scrape 10 years of daily news data. We used two prolonged approaches. First, for general news, we scraped the top 10 daily headlines from the website just mentioned, takemeback.do, and CNN. For this, we used Python's beautiful SOAP library, which is excellent for parsing static HTML pages. Second, to get more domain-specific data, we scraped financial news and articles from the New York Times. The New York Times website is dynamic and requires interaction, so we use Selenium to automate our web browser, iterating day by day using a Python's datetime module to gather the articles. After scraping, we combined the headlines from takemeback.to and CNN to minimize any days with missing data. We then replaced this entire scraping process for our test period of 22 to 23. You can refer to this code. I have what is this? Okay, under the scripting data section, you can see I have imported libraries like Beautiful SOAP and Selenium, and the function which I have made convert to HTML and extract news show the logic for scraping the static sites. The financial function shows that more complex logic using Selenium to navigate through the New York Times, and it handles the dynamic content and extract relevant articles. The step 2 is sentiment analysis and feature extraction. Once we had our raw data text, the next step was to convert it into numbers our model could understand. First, we clean the dataset by removing all punctuations, leaving only the words. Then for the core sentiment analysis, we use a powerful pre-trained transformer model from Hugging Face called Robota, and we train this on a GPU to process the data efficiently. For each headline and article, this model gave us three scores: positive, neutral, and negative. To get a single single sentiment signal for each day, we took the mean of the scores across all the headlines for the day. Finally, we performed some feature extractions. We incorporated a well-known market anomaly called the day of the week effect. News from the weekend, Saturday, Sunday, often impacts the market open on the Monday. So as you can see from the formula, we calculated a modified modified score for Mondays that factors in the sentiment from the preceding Saturday and Sunday with an exponential decay. You can refer to this code I have made and it's in my notebook in sentiment analysis section. I have used remove punct function. The main sentiment analysis function is where the magic happens. You can see us loading the auto tokenizer and auto model for sequence classification with Roberta model. The function then iterates through the data, calculates scores and aggregate them. You can also see Monday score function, which directly implements the weighted average formula we just discovered. Okay. Here the third step, training training the model. Historical data is taken from historical data is taken from Yahoo Finance, from Amazon for the period of 2012 to 2021. Labels are created for each based on the following criteria. K, if close of n is less than close of n minus 1, then the label will be 0, and it will be 1 for close of n greater than close of n minus 1, where close n is the closing price of the nth date, and similarly for the close n minus 1. Lagged features and moving averages are calculated for closing prices, also as done earlier for sentiment scores. Features extracted from the sentiment analysis are merged with this data. Only the lagged features and moving scores are taken in the final training data for machine learning models, and the target variable is label. The data is split into 80-20 ratio for the training and testing ML models. The classification model includes logistic regression, decision tree classification, classifier, random forest classifier, XGBoost classifier, support vector, and linear LDA are used for training. The fourth step is model evaluation. All the models used are evaluated based on the following metrics: accuracy, precision, recall, FN score, and ROC curve analysis. After all this evaluation, we found out the best model comes out to be the linear discriminant analysis with the metrics which are set in the notebook, which are present over here also. Okay. And the fifth step was calculating portfolio. A new data set was prepared by scraping data for the period of 2022 to 2023. The data set was pre-processed as in for the training data, and the selected model is used to predict the target variables. A trading strategy is then devised, and buy and sell points are identified, combining the strategy and predicted output. Trades are made for the stock, and the final portfolio is calculated. Portfolio metrics like Sharpe ratio, maximum maximum drawdown, and win ratio are also calculated. The RP here stands for the return of portfolio, RF stands for return of risk-free rate, sigma stands for the standard deviation of the portfolio's excess return. The maximum drawdown here has trough value minus peak value upon peak value, as you can already think of it clearly how it works, what these terms mean. Win ratio is number of winning trade upon total number of trades into 100. Okay. Then we made trading strategies for overnight trading. Now we have seen the sentiment features. We need a strategy to trade on them, and we have this overnight trading strategy, which means we place our trades after the market closes and before it opens the next day. Our model doesn't just use today's sentiment. Instead, it predicts the nth day's price change by looking at a window of past data. Specifically, The lagged and the moving averages of sentiment scores are and closing prices for the n-1 data back to the n-1 day. Based on their prediction, we execute our trade at the n-1 day's closing price, holding the position overnight to capitalize on the predicted move at the nth day's open. Yeah. So, within our overnight strategy, we adopted a contrarian trading approach. This strategy is built on the idea that markets are often overreact to news. So our logic is inverted now. If our model predicts the stock price will go up, we assume the market has overreacted and the market is overbought. So we issue a sell signal, betting on a correction downwards. Conversely, if the model predicts the stock will go down, we assume it's oversold and issue a buy signal, betting on a rebound. We also adopted an aggressive capital management style. On a buy signal, we invest all the available cash, and on a sell signal, we sell all shares on that stock. We have this code. In this, you can see the contrarian logic in the notebook's trading simulation section. There's a loop where if the predicted value is 1, which means up, the signal is set to -1, which refers to sell. And if the predicted value is 0, which means down, the signal is set to 1, which refers to buy. Okay. Then we do the portfolio analysis. To test this strategy, we have created a hypothetical portfolio. We started with an initial investment of $30,000. This capital was split equally with $10,000 to each of the three major tech stocks: Amazon, Google, and Microsoft. As you can see here in the slides, the next slide will show the result of each stocks individually. The first slide is for the Amazon. The next one is for Google. The next one is for Microsoft. We will start with Amazon. The first chart you see plots the buy and sell signals. The green triangles and the red V's are plotted in the plot. The whole plot basically shows us exactly when our model told us to trade, what our model told us to trade. The second chart shows the growth of our initial $10,000 investment in Amazon over the 2 years period. For the Google, again you can see the buy and sell points on the corresponding portfolio over time. Same for the Microsoft. In all the cases, the strategy was able to generate positive returns. These plots are generated in the final section of the notebook. For each stock in our portfolio.stock list, the code generates these two exact charts, one with plt.scatter for the buy sell signals and one with plt.plot for the portfolio value. Now we have this final portfolio thing. This slide shows the result we've been building towards, the combined value of our entire 30,000 portfolio over time. The line represents the sum of the individual Amazon, Google, and Microsoft portfolios. As you can see, the growth is substantial. We started with $30,000, and by the end of the test period, the final portfolio value is resulted in a mean final return of something 139.57%. This result is calculated in the very last code of the notebook. I have also attached it here. We sum the portfolio value columns from all the three stocks to create the combined portfolio list. We plot this list to create the chart you see here. Finally, the final returns variable is calculated and the notebook prints the exact line. Now we go on to the results of this whole project. Now, as we all know, 139% is an incredible return, and we need to add some important context. That very high return was largely driven by the exceptional performance of Amazon portfolio. This is likely because the model was trained on Amazon's historical data, which may have made it particularly good at predicting its behavior. We we may consider the Amazon result as a potential outlier. The adjusted return for the other stock in the portfolio were closer to the 40 to 50% range. This is still a very strong and impressive result, demonstrating the viability of the sentiment-based strategy. With this result, we come to the limitation of the project. All the first part was overnight trading. This strategy operates in after-hours market. This market have fewer participants, which means lower trading volume and liquidity. This can lead to high volatility and significant price gaps between the closing and opening prices, which introduces risk. The second is contrarian strategy. A contrarian approach bets against the trend. If a strong market trend driven by fundamentals persists for a long time, our strategy could suffer significant losses before a correction happens. Third is market timing. The aggressive all-in or all-out approach is highly dependent on precise market timing, which is notoriously difficult to get right every time. These are all the critical factors to consider before deploying such a model in a live trading environment. That concludes my presentation. Thank you for your time. I'd be happy to answer any questions.